So buying a home at the top of your approval amount is not only risky, it could be the reason you end up losing the home if life hits you with the unexpected. And I've seen many buyers, they get approved, they start celebrating, they move in, and then months later they're drowning in payments that they truly weren't ready for. So in today's video, I'm going to go over the truth on how lenders calculate your approval amount and why that can set you up for financial stress and not success. We'll also go over different budgeting tips using real life scenarios of $50,000, $70,000, and $100,000 of income. Now let's get into it. So the number one formula the banks look at in order to determine how much your buying power is or how much you're approved for is called your debt to income ratio. And this is just a formula that shows the banks how much your monthly income goes towards your monthly debt. And how they calculate it is they add up all of your monthly debt. This also includes your future mortgage payment, divide it by your monthly income. This gives them a percentage, and the banks really don't want your DTI to go really higher than anywhere from about 45 to 50%. So this means that the banks are okay with 50% of your monthly income, which is gross, to go towards your monthly debt. And this is where a lot of buyers make the mistake because they assume that just because they got approved for that amount, they can afford it, it's a financially good decision. That's not the case. Remember, the banks are there to protect themselves. They're not your financial advisors. And you have to remember that in this equation, they are not taking into consideration your other bills as well, like gas, groceries, insurance, cell phone bills, utilities, things like that. What they do take into that consideration as your monthly debt is going to be like your car payments, your credit card bills, student loans, if you have any child support, any personal loans, alimonies, the future mortgage payment, things like that. So let's say your gross monthly income is about $5,000 a month. So in general, the banks will allow $2,500 of that $5,000 a month to go towards your monthly debt plus the future mortgage payment, allocated that together. Now, let's say you have about $1,000 a month of monthly debt. This includes all of your car payments added up, your student loans, your credit card bills, things like that. They will approve you for a $1,500 a month of mortgage payment, which it can be anywhere from about a $200,000 purchase price to a $225,000 purchase price, depending on your area, the taxes, insurance, how much you put down, things like that. But let's say you get excited, you're like, cool, I can find a house price in my area that I like. Here's how it breaks down in real life. So really a $5,000 gross amount is going to equal to about $3,800 of net, what's in your pocket. So if you take your net amount minus the mortgage payment, minus all of your monthly debt, that only gives you about $1,300 a month to live on, to save for retirement, childcare, groceries, things like that, which is very tight. So that's why it's important to really understand that just because you got approved for that amount doesn't mean it's a financially smart decision to buy at the top of your approval. Now let's go over a formula that you can use that will help you not become house poor. So in order to truly understand how much you can afford and how much maybe you should be spending on a mortgage payment, you want to make sure you're basing everything off of your net income amount and not your gross amount, because your monthly net income amount is actually the amount that's going to be hitting your bank account after taxes. Now, a lot of financial experts advise that you want to keep your housing payment to about 25 to 30% of your monthly income. And this should include everything out the door, including like property taxes, home insurance, also HOA as well. And before you even think about getting pre-approved, you want to make sure that you know your budget up front. Because a big mistake I see a lot of home buyers making, especially first-time home buyers, is they do not know up front where they want to be as far as monthly payment goes. And remember, the lenders and the banks are pre-approving you based on the max amount. And a lot of times, if you go in there blind eye, then you get excited and you lose sight on actually how much you can truly afford at the end of the day. Now, a tip that I tell a lot of buyers that don't really know exactly what their max amount of their affordability is, I always tell them, simulate the experience. Let's say you think that you want to be around the $2,000 a month mark, but you think you could stretch it to like $2,500, maybe a little bit higher. Tell people, simulate the experience. Use the next 3 months and act like your rent amount is the highest amount, $2,500, and see if you can keep up with the same lifestyle, see if you're able to save, and that will be a good indicator to tell you if that would be a good amount moving forward. Now, before we go into how much you can afford based on a $50,000 a year income, if you're planning to buy a house this year, make sure you hit that subscribe button so you get notified every time I put a video out. So here's an example of how the banks qualify you if you make $50,000 a year of salary income. So they're gonna take your yearly salary amount, divide it by 12, because there's 12 months in a year. That's gonna give you your gross monthly income. Then they're gonna take your gross monthly income, divide it by 2, and that's gonna give them $2,083 a month. Now remember, the reason why we're dividing this by 2 is because generally speaking, the banks will allow 50% of your monthly income to go towards your total monthly debt. So right here, this is the amount that your total monthly debt cannot exceed, also including the future mortgage payment. So you're gonna take that number, subtract it by how much your total monthly debt is. This is all of your car payments, student loans, credit card bills on a monthly payment base added up. And that's gonna give them how much they will approve you based on the mortgage payment. So in this scenario, they're gonna approve you for a mortgage payment of $1,583. Now, if you had a lot higher debt, then you would get approved for a less mortgage payment amount. So in this example, this mortgage payment is probably gonna equal to around a $200,000 purchase price, depending on your area, and this payment must include, this is including taxes, insurance, and HOA. Now let's go over a similar scenario, but using your net amount. Okay, so let's say your net income is around $3,400 a month. Now this number is gonna be very dependent on your situation, also the state that you're in. But let's say you only wanna spend about 25% of your net income to go towards your housing payment. Then you wanna keep your monthly mortgage payment around $872 a month. And let's say you want your budget to include 30% of your monthly income to go towards your housing payment, then that's gonna include your payment to be around $1,000 a month. So you can see the vast difference between how much you should budget for and how much the bank is going to approve you for. Now let's go over the scenario of $70,000 a year. So here's how the banks qualify you if you make $70,000 of yearly salary income. They're gonna take your salary amount, divide it by 12. That's gonna give you your gross monthly income. Then they're gonna take your gross monthly income and divide it by 2 because you can only use 50% of your monthly income to go towards your total monthly debt. That's gonna give you $2,916. Now this $2,916 has to include all of your monthly debt plus the future mortgage payment. So what you can do is you take that amount, subtract your total monthly debt. This is your car payment, student loans, credit card bills, installment loans, add it all up. In this example, we're using $800 a month. Then that will give you $2,116. That's how much of the mortgage payment they will approve you for. And an average mortgage payment based on that amount is gonna give you a purchase price anywhere from about $250 to about $275, depending on the taxes and insurance. I'm using a very conservative amount for that. Okay, so now using your net income, let's look at how much you probably truly can afford without stretching yourself too thin. So your net income is probably gonna be around $4,700 a month. Now, this is going to change depending on your situation. It's gonna depend on what state you're in. But if we take your net income, and let's say you only want 25% of your net income to go towards your mortgage payment, then you're gonna keep your mortgage payment to around $1,182 a month. Now, let's say you can stretch it a little bit more and you want 30% of your monthly income to go towards your housing payment, then you wanna keep it to around $1,400 a month. Now let's go over a scenario with $100,000 of yearly income. So if your salary is $100K per year, the bank is gonna use $8,300 a month for your gross income. Then they're gonna divide it by 2. That's gonna give them the max amount of monthly debt that you can hold, and this includes all of your debt payments added up and also the future mortgage payment. So then you're gonna take that amount, you're gonna minus all of your monthly debt. In this example, I'm using $1,000 of monthly debt. This is car payments, student loans, credit card bills, things like that. Then that will give you your max mortgage payment that you can qualify for. In this scenario, it's gonna be $3,100 a month. $3,100 a month is, give or take, gonna be equal to about $400,000 to a $425,000 purchase price. Now here's how it contrasts with your personal budget. So if you're making $100K per year, your net income is probably gonna be around $6,600 a month. And this again depends on your state, depends on your specific scenario. Then let's say you want only 25% of your net monthly income to go towards your housing payment or to go towards your mortgage payment. Then you need to keep your mortgage payment to around $1,650 per month. Now, let's say you want to stretch it to about 30% of your net monthly income. Then you want to keep your mortgage payment to about $19.80 per month. So you want to make sure that you base your home search based on your monthly payment, not necessarily the purchase price. And when you do that, you're really reverse engineering where you should be looking as far as purchase price based on what you're comfortable paying a monthly payment. And you can use different websites on Google that has mortgage calculators, but just beware whenever you're searching on Zillow and it has the mortgage calculator at the bottom, that's showing you best case scenario, showing you a 20% down. Also, the property taxes, home insurance is not accurate, so they show you a lot lower payment than what's the reality. Now, here's a couple things that you want to plug in when using a mortgage calculator. Put the interest rate anywhere from about 6.5 to 7%. You can put the down payment 3.5% as minimum down payment. You can play around with this as well. Also, when it comes to home insurance, property taxes, look up the average cost that's in your area because it's going to depend from state to state, from area to area. Like down in Miami, the home insurance is like $10,000 for the whole year. In Utah, it's about $1,000. So it's really going to be dependent on where you live. Now, a big mistake that I see a lot of home buyers making is they start just looking at homes based on the price and not on the actual mortgage payment itself. Then they get disappointed, or they're not looking in a realistic amount that where they need to be as far as their budget goes. Now, a tip whenever it comes to searching based on monthly payment, come up with 3 monthly payments. Come up with a conservative amount, come up with one that's more comfortable for you. Also, come up with one that stretches you just a little bit so that you can see the difference in home prices where you want to be at. So you really want to make sure that you understand your budget first before you even get pre-approved, so that during the pre-approval process, you can work with your lender and tell them, hey, I want my mortgage payment to be X amount. What purchase price do I need to be looking at? Don't allow the lender to determine your affordability, because a pre-approval does not equal affordability in your case. At the end of the day, you know your situation best. Now, if you love this video, then you're going to like the one that I did that went over everything you need to know on how to get pre-approved in 2020.